So wish you great success. We'll now go to the gentleman from Illinois, Mr. Casten.
Thank you, Mr. Chairman, and we will miss you on this committee and wish you all the best in whatever follows. I want to talk a little bit just about some of the premise of this hearing, because I think there's two very different ways to describe the narrative of what's happened in public markets since the 90s. One narrative, which I think has been told quite extensively here and in the preparatory materials, is that it's harder to go public. Fewer people were saying the decline of public company IPOs, of the burdensome nature of regulation, and we all have heard that story 1,000 times. There's another version of that story that says that institutional investors woke up in the 90s and said, maybe we can do things besides just investing in stocks and bonds. We can allocate to alternative investments, chasing yield. Endowments, pension funds started to run in that direction and opened up tons of opportunities that didn't exist before for funding. Those are both valid stories. And what I find somewhat strange about this job that I'm in now is that I was 16 years in the private sector before running private equity-backed companies, and I only heard that second story. Since getting to Congress, I've only heard the first story. And as I think back to my time, I was jealous of my fellow CEOs who ran public companies, because they didn't have some annoying punk 25-year-old recently minted Harvard MBA telling them how to run their business every day, who was very sophisticated, of course, but had opinions that didn't match my wisdom and entrepreneurial vision. And I would lament to my public company CEOs about how much more freedom they had, because they had a diffuse set of investors, and they would say to me, hey, the grass is greener on your side of the fence because I've got all these disclosure rules. I think both of us were right in our own way, but both of us were constrained by the burdens of investor protection. In my case, I could not raise capital except from sophisticated people, and in their case, they had disclosure obligations to protect unsophisticated people. And the concern I have is that if we only listen to that first story, then we're going to say, our mission here is to increase liquidity, increase access to less sophisticated people, and do nothing to actually protect them from all those crimes. And I'm going to be candid with you. Like, if I was still a CEO, if I felt like my job here was to protect our nation's beleaguered CEOs, I would push for opening up as many unsophisticated players to capital markets as possible, because it makes the nation's CEOs' lives much easier. I'm not sure it's good public policy. So I guess I want to start, Mr. Coley, you had suggested that some of the illiquidity in private markets limits participations, but that innovation can fix that. And I guess I just want to understand from you, do you believe that that is fixable in the absence of a robust regulatory regime to provide investor protection? Is this just a technological fix, or do we need to also do things to make sure that that expanded liquidity provides protections for people participating in that liquidity?
Thank you for the question. Yes, I do believe that without opening up access to the private markets to unsophisticated investors, there's still rulemaking that can be done to allow for more liquidity to flow within the private markets. I am actually with you that we want to be careful about opening up the private markets to unsophisticated investors. The private markets exist and do a great service to help these young, hungry startups to build a stable business over time, such that by the time they hit the public markets, they're stable, there's predictability and reliability, and I do agree that you want to have that separation between.
Okay, so we still need the investor protection, and then Mr. Ward, you had testified, I think when you were here a year ago, and I hope I'm not misquoting you, to the extent that financial markets are always led by institutional investors and retail follows. I'm intrigued, and I think you and I have spoken before about this idea of sort of, a public fund investing in private funds. Would you be supportive of making sure that those vehicles, that the people who are participating are the sophisticated institutional, because I personally feel better about that if you're saying, okay, I trust that Fidelity is going to manage this well. But that's a separate question from, Ma and Pa Kettle. So would you support appropriate constraints about who can actually participate in those public funds of private vehicles to ensure that protection is there?
Congressman Casten, I loved your framing of the first or the second, and I'm actually a believer. I agree with you in the second. I do think that the idea that unsophisticated investors exist in the private markets but not the public is an old one. That how many public market investors actually read a 10K, for example, or a quarterly earnings report?
Well, there's sophistication of knowledge and sophistication of can you afford to lose what you're losing if you don't read, right?
For sure, sir. And I think, but there's no limits on how much they can afford to lose in the public markets as well. And so I would argue that I agree with you. I think more access to private markets is the right way to do it, but it should be structured access. I'm not a huge believer that anybody could invest in any company at any time. That professional management, at least to start, is the right way to liberate the private markets.
Okay, well, I see I'm well overdue, but the chairman's generosity is continuing, so I appreciate it. And I will now yield back.
The gentleman from Michigan, the chair of the Oversight Subcommittee, previous chair of the Capital Markets Subcommittee.